Gonna, good afternoon, everyone. We're going to give another 60 seconds before we start the webinar. All right, I think we got everybody in. Good afternoon, as I mentioned. Thanks for joining us today on our webinar, Exploring Regional Commercial Real Estate Opportunities and Alternative Investments via Self-Directed IRAs. I'm Liam Bulin. I'm a Sales Director at Forge Global, and I'll be your host today. Before we dive in, a few housekeeping notes. This session is being recorded. So we'll have that available if you want it. And then feel free to submit any questions you have throughout the presentation using the Q&A feature in the bottom. We're very fortunate I'm very fortunate to be joined by two experienced real estate professionals who are making significant moves across the Sun Belt and Southeastern markets. And one of them is Bill Green. He's the co-CEO and principal at Ginkgo Residential. The other is Tyler Arrington. He's partner at Staubach Capital. And, we're going to explore their outlooks on real estate and in their respective regions, how they're navigating today's capital markets, and I'll touch a little bit on how self-directed IRAs can be used to invest in opportunities like theirs. So I'll turn it over to Bill and have him introduce himself and Ginkgo.
Great. Thank you very much. Most of my career was spent in banking and asset management, but all of my career was spent in real estate in some way, shape, or form. I had the opportunity to catch CMBS at its infancy and had the opportunity to start the conduit program, the commercial mortgage conduit program at Bank of America in 1994. But then subsequently, I went to Wachovia and ran their global real estate capital market business for 8 years, where we were actually the largest deployer of capital in the world. I joined Ginkgo in 2012, who was a client of mine at the time. And early in my career, I'd also been involved with a multifamily platform. Ginkgo is a legacy firm that's been around for 40 years. It has been public, it's been private, it has been a syndicator, we'll go through what our new iteration is right now. But the one thing it's always been highly concentrated, and it's always been focused on workforce housing.
Thanks, Bill. I'll intro now. Tyler Arrington, thanks everyone for being here. I'm a partner at Staubach Capital. I also serve as the Chief Investment Officer of Resi, which is our SFR platform. We'll touch on a little bit of that today. My background is all things real estate finance. Prior to Staubach Capital, I was with Hillwood, Ross Perot Jr.'s real estate development company, in a few different roles, and then joined Staubach Capital in 2018 with Jeff Staubach and the Staubach family. Who have a long legacy in and around real estate. Also a few Super Bowl rings and MVP rings to boot. So Liam, I'll pass it back to you.
Sure. I think now would be kind of a good time to turn it back to start with Bill and get kind of your house views on what's happening in the Carolinas. I know you guys have kind of a strong thesis on debt maturity pressure and interest rates and supply in Carolinas, and love to see what's driving your conviction in the market, in the Carolina market, and how you're positioning Ginkgo to take advantage of some of these trends.
Great, thank you. I'll just actually go through what our lens is right now, and this is kind of what our business is. So it'll give you a sense of where I think the market is. We invest in basically older housing. We preserve older housing. That really is by definition workforce housing. We do value add. So basically, the business model that we really participate in is focused on renovation, rehab, and really extending the useful life of the asset. What we look for though is we are not short-term grippers and flippers. So we compete against people that do that, but for the most part, we operate against people that are investing for 10-year plus holds to get long-term benefit and really gain the benefit of what they're doing. We're vertically integrated, so we understand the challenges that are really necessary in older vintage assets, and sometimes People either overlook that or they think it's too daunting and they don't pursue it, which creates opportunities both ways. In order to do what we do, and really any level of multifamily, we're constantly under pressure to figure out ways to improve the lifestyle of our residents. And so you end up doing a lot of things that are energy efficient, that lower water consumption, and really bring down the operating environment. But we don't do it all equity. We do it with leverage, not a high amount of leverage. And I think anybody who can get through any cycle finds out that high leverage is really great to make really quick gains, but every once in a while the tide goes out. So with that, our house views when we look at where the market might be right now, if we want to just roll this forward a page, you know, you know, people who bought assets and a lot of people came into the market in our markets in 2020 through 2022, with a lot of them actually being West Coast people that had invested in assets and got caught on the wrong side of buying, very, very low cap rate assets with short-term debt, but also from the Northeast. And they started to diversify into the Carolinas, people that had not really invested much in the Carolinas really until around 2022. And they just bought a lot of assets at really low cap rates with, even at the time, slightly above cap rate financing. And right now, a lot of that debt is coming due and they're caught on the wrong side of that. So even with that, we do think that in general, interest rates have more of a flat to a downward momentum at this point. Obviously, that can geopolitically change every 5 minutes right now. But what we do see is we do see from a valuation perspective that in our markets right now that cap rates for stabilized assets are generally 5.25% to 5.5%, and really cap rate can mean a lot of things, but when we see 5.25% to 5.5%, when you're going to buy assets, you're really that's your first year forward view. When you're financing things and when you're lenders, et cetera, they tend to look at trailing 3 or trailing 12 months. But we look at it, the market we're seeing is 5.25% to 5.5%. And some of that's based on sales we've done recently and assets we've purchased recently. Even though the Carolinas, and again, this is narrowly focused to what we see, we've got great demographics consistently. We've got over 150 people a day move to Charlotte, 95 to 100 move to Raleigh, call it 300 to 400 move every day to the Carolinas. But with it, we see a moderation in rent growth right now, and that's really associated with the next bullet point. We have new supply. So even though directly we never compete against brand new apartments come in with rental asking rents that are 1/3 to maybe even 40% higher than our rents. Over time, if there's too much supply, that tends to bump into our supply and it puts pressure on occupancy. Residents start to trade up or trade down, and it does cause a disruption. So we're seeing moderating rent growth in our markets right now. But with it, what's a little bit unique about both North Carolina and Texas is our relocation it's not retiree relocation. It is predominantly people in the meat of their careers. And so our relocations come because North Carolina is a very friendly place to work. It has great job opportunities. So we get a very young, dynamic level of in-migration versus potentially just retirees who might be looking not to spend and they're looking to preserve assets. But the biggest thing that I think is really touching the whole country right now is in this interest rate environment and with these prices, home ownership is basically not approachable for young kids. And as a result, they're becoming more long-term renters. Even most of the sale activities right now, believe it or not, most of the sales in the United States are still controlled by baby boomers. So people 55 and up are still the predominantly largest buyer of homes in the country. And that's never really happened before. So those are what we see. Overall, if I was going to summarize, I would say in the short term, it might be a little bit of a sideways market in the Carolinas, but our long-term demographics continue to look good and our supply seems like it's getting under control.
Awesome. Thank you for sharing that. And so I guess that kind of leads us to you, Tyler, and Texas, and I guess the broader Sun Belt, like Bill was saying, are also are magnets for growth, right? And kind of some of the similar demographics that Carolinas are having. What's your view, and how is Staubach, responding?
Yeah, no, thanks, Liam, and thanks, Bill. Before I get into kind of our house views, I will touch on, Carolinas and Texas are very similar, kind of to what Bill hinted at, right? There's a lot of in-migration. So I think we both benefit from different aspects of like that, including pro-business, et cetera. But just really quickly, just to talk a little bit about what we do. We have deployed, in the last 7 or so years, we've deployed about $375 million across a few different verticals, but largely around residential. A third of that is basically multifamily development. So a little different than the kind of workforce housing that Bill was hinting at. This is Class A multifamily. All of that is, or largely that is in Texas. A third is in single family for rent. So acquiring brand new assets, similar to what Bill said earlier, right? There's definitely some pressure because of interest rates to where retail buyers just can't afford them. So we're acquiring those and managing those. And then the last third of the business is kind of other being relationship-based deals, industrial acquisitions, self-storage acquisitions, retail development. So it's nice that we are kind of product type agnostic, and we don't have a fund. We raise money deal by deal. So I'll transition to kind of our house views, which are, it's funny, they align a little bit with what Bill was hinting at, right? I mean, number one, we definitely believe in the fundamentals of real estate in general. If you compare it to other kind of investment classes, i.e., you're buying a physical asset, that asset has value. Generally, it's producing income, and so we believe in that. Plus, you get the other benefits of depreciation and things like that. And like I touched on, Texas is obviously booming. Just people moving here every day. I don't know how it compares to the 150 that Bill quoted, but I've heard stats of 300 plus to DFW specifically a day. I can't cite that source. I apologize. But I think a lot of our kind of macro level thesis is kind of, just is around the housing shortage in the United States, which, 4 to 5 million, depending on which site you source. And that is putting pressure on just the housing market in general. And so we're big believers in residential, whether it's workforce housing or Class A multifamily or single family for rent. People have to live somewhere, and there's just not enough households or not enough houses for the households, whether that's multi or single family. And so we are experiencing some of what Bill touched on of kind of just stagnant rent over the last, call it 18 to 24 months. Because in Texas, similar, there was a ton of supply that was delivered, whether it was Dallas or in Austin, a ton of supply got delivered. And that was obviously pushing rents down because to Bill's point, people could, go up or go down in that stack of multifamily or single family. I will say on the single family side, we have seen rent appreciate over that same time period compared to multifamily. And I think largely that's because, most of our product is brand new assets. And people are going from a 2 or 3 bedroom apartment to a 3 or 4 or 5 bedroom house. And then I think lastly, obviously as this supply burns off, I think that's ultimately going to transition to rent growth in all things residential, whether it's, kind of the workforce housing or the Class A or the single family for rent. So I think that kind of summarizes our general house views. I'll pass it back to Liam so we can get into some Q&A. Oh, wait, I'm sorry. We're going to self-directed IRAs.
Sure. Yeah, we have a lot to touch on the Q&A section. We've already gotten some questions that we'll get into. But yeah, just wanted to do kind of quick highlight of basically the role self-directed IRAs play in alternative investments, and then kind of what we're seeing in the space. And so first at Forge Trust, basically what we do is we help investors unlock their retirement accounts, whether it's an old 401k or an existing IRA, and access and invest in alternative assets like real estate, private equity, private capital, venture capital, startups, all those types of everything, metals, notes, anything you can really kind of think of that's beyond the traditional stock and bonds. But we don't give investment advice or tax advice or endorse any particular products. We just aim to make it easier for investors to use their IRAs to access opportunities that they believe in, like real estate. And I guess that kind of leads to what we're seeing in the sort of SDIRA space. And it's a lot of investors are looking for ways to diversify beyond the public markets, right? With rising volatility and lower expected returns from traditional stocks and bonds, many are looking to tangible income producing assets like real estate, and they're doing it through retirement accounts, right? So self-directed IRAs give investors the freedom to invest in what they know. And it's great because these investments can grow with either tax deferred, like in a traditional IRA, or tax-free in the case of Roth IRAs. And so we're seeing a lot more capital flow into private deals, and we work with sponsors like Ginkgo and Staubach to make sure their investors and all investors that want to and can use their retirements to efficiently and compliantly, and so they can invest their retirement dollars into their funds. And it's not really about like replacing your advisor or abandoning traditional allocations. It's about expanding your investment toolbox and gaining access to investments that have typically only been available to institutions. And so kind of level the playing field a little bit for regular investors. And I'm sure you guys seen any interest in investors asking about SDI using retirement accounts?
We get about 20% of our high net worth investors are using IRAs in some way, shape, or form. We have two basic ways they do that, and we'll talk a little bit about our product, I think, just at the end. But we operate predominantly out of a non-traded REIT. And that non-traded REIT is again, it's our portfolio in North Carolina. We have about 8,000 apartments. We do that both directly owned, but the REIT will also joint venture. But there's an exemption under the tax code for real estate investment trust where the UBIT doesn't apply. So we have leverage on our assets, but you have no UBIT issues whatsoever if you're a real estate investment trust investor. But then something I think is a little bit closer to both of our businesses. We still, we'll do sidecars with high net worths on some of our larger assets at times, together with outside more institutional partners. And what happens in the first 5 years of any real estate asset, and multifamily in particular, you have enough depreciation operating losses that it really negates the impact of having any technical income that would be subject to UBIT. If you're in an asset for a really long time, though, you could get upside down on that, and that could become problematic. So just in general, IRA investors, if they're going to invest in real estate directly, they need to make sure they keep recycling their assets.
Yeah, I would echo Bill's thoughts there. We definitely have a large number of investors who use IRA or self-directed funds to invest. To Bill's point, we're fortunate in that most of our deals, are 5-7 years, and so the depreciation and the accelerated depreciation usually cover the UBIT tax for self-directed holders.
Right. And it pairs nicely. It's IRAs, right? Our long-term committed capital, and it's long-term investment. So nicely.
Hey, Liam, while we're on this, I see we got a question in. If an investor has a self-directed IRA with another custodian, can you assume those investments? Could they transfer that over?
Yes, they could transfer it over.
Okay.
Simple paperwork. Contact us. We'll give you the contact information towards the end, but we can transfer any pretty much, as long as it's a legal asset, we can transfer it over to Ford's Trust and hold those assets.
Awesome. With that, anything else on the self-directed IRAs, and then we'll.
No, I think we should probably dive in. I had a number of questions come in already. So one of them, the first one was around is on interest rates, right? Something that's been on basically everybody's radar, especially in the real estate world. And so the first one here is how have each of you navigated the last couple of years in a higher interest rate environment? And has it been harder to make sense of deals? Have you adapted your investment strategy at all because of them?
Go ahead, Tyler.
Yeah, so I would say right off the bat, right, higher interest rate environment makes all deals harder to make sense of. I will say from the Staubach Capital side, we've definitely been more strategic and thoughtful. Not that we weren't before, but we've just been, hyper focused on not going after deals where every drop in the bucket has to hit. Because to what Bill said earlier, right, there's a number of folks out there who are on the wrong side of the tracks now with higher rates kind of staying for longer than what the market, quote unquote, has thought. I remember 12 months ago, everyone thought rates were coming down and they still haven't, or maybe they came down slightly, but they're still, elevated. And so it's definitely causing us to be just super focused on, being able to execute the business plan without every needle or every drop having to hit in the bucket. So it's forced us to be ultra conservative. And I will say, we've done less deals over the last 12 to 18 months because of it. Because for us, we don't have to deploy capital. If we see a deal or an opportunity that makes sense, then we'll pursue it. But it's definitely caused us to focus in a bit. Bill?
Yeah, so for us, it's a little bit of a tale of two cities. The one thing overall is our underlying portfolio, because we own 20 to 30-year-old assets, we're not competing directly with new supply. So what's unusual for us as an asset class is even this year, our revenue in the first half of this year across our 8,000 apartments, it's up 5%. Our bottom line is up 8%. Last year, it was up 7.4% for the year. The year before that, it was up 11%. And so we just didn't compete with that dead on new supply issue directly, but we're definitely seeing it starting to get our rent increases revert to historic norms. So the inflation that caused for rates to go up is highly correlated to real estate and specifically multifamily real estate. And if you look at it long term, second generation multifamily operators tend to be some of the wealthiest, strongest people in the world because multifamily industry is really set up to be an inflation hedge if you can hang in there for a long time. But the second part of this is how is our portfolio position coming into it? And as I indicated, Ginkgo REIT has about half of its equity and a third of its assets are wholly owned. And those are all long-term fixed rate finance. We took advantage of low rates. We've got maturities going out to 2032 at rates that range from 3 to 5%. And so we're pretty good about that. But we did struggle with some of our joint venture partners who wanted the optionality of floating rate debt. And all of a sudden, we had caps that went 3 and 4 years and they just weren't long enough. And so it became a little bit more painful on the exit. And so where we find the market right now is it's a capitulation point. We happened to be successful enough that we had strong sponsors with us. We didn't have a ton of leverage. Our recapitalization, if it was a cash in, wasn't severe, but there's a lot of people that have just run out of cash right now.
Mm-hmm. Bill, do you think that there's been a lot of lenders who have kind of kicked the can down the road? Because I think we're kind of seeing that here is that we hear the blood in the water, but we don't necessarily see it per se. There's a couple headlines here and there, but
You know, I do sit on a public board that is a mortgage REIT, and so I see what they do. And what I can tell you in general, it's and I'm not speaking to our company at all, but I would say what I see in the bank market is the bank market, at least in multifamily, seems a little bit less likely to kick the can down the road unless they're really upside down. So if they made a 60% loan and now it's 75, 80%, they're not exactly afraid of their position and they tend to play a little harder with you. And so, but if you went in and they had a 75% loan that's now a 90, 95% loan, nobody's going to bail them out. And they're actually more prone. This is me just anecdotal. I don't know if this is accurate, but they seem like they're giving much better deals to these people that can actually impair their value. And they're actually treating their more conservative clients a lot rougher.
Mm-hmm.
And I have no idea if that's accurate. That's just how it feels to me.
Yeah, interesting. Liam, pass it back to you.
Sure. I guess kind of dovetails a little bit off of the interest rate and maybe touched on it is kind of dealing with financing. Have you guys explored any kind of creative financing options to make the deals that you are working on work when traditional kind of loans are a little less favorable?
We bought a deal all cash recently. And so there's two parts of what we buy. Again, we're buying older assets and a lot of times from people who did renovation plans that they might have then overspent off a very low basis. And so we bought an asset in Wilmington that appeared to be a pretty good operator. They weren't local to the market, but they were a good operator, but they bought it at like a sub 4% cap rate in 2022. They invested a lot of money. And in a nutshell, their basis ended up being about $42 million. We bought it for $31 million, basically $1 million over the debt, simply because they weren't in position to write an $8 million loan to resize their debt. But the asset was so destabilized that our financing offers were inadequate. And so we actually went out in the market and found somebody willing to buy it all cash with us. We did a 90-10 deal, and we just wanted to wait until we kind of achieved a lot of our business model, and that's turned into a really nice relationship for us. And that's something I could never have envisioned just 3 years ago.
Mhm. Yeah, on our side, I think we've done a few self-storage deals that are seller financing, which I'd say generally speaking, when it's seller financing, you can get lower rates. So we're in the fours on a couple seller financing deals. And then I think outside of that, right, Bill hinted at it, but reserving cash for new rate caps, things like that. That's kind of to the extent of our kind of creative financing. I guess in certain instances, maybe like some pref equity, but outside of that, that's kind of.
And so, like, how are you going about trying to find some of like this $31 million deal that you talked about, Bill? Like, how are you guys? What's your strategies to identify sort of these undervalued properties and or good deals and this kind of competitive or unpredictable market?
What we're finding right now is the opposite of what it was in the late 2010s and through, call it 2015 through 2020, where large deals tended to get bid tighter. It's actually the large deals where there's less capital available. And so for us, we're focused on slightly larger deals with larger equity checks than we have in the past. So we're much more focused on doing joint ventures than buying assets wholly right now, and finding sponsors that have new funds or that have excess capital to put to work. And for us, we care about people that are looking at things with more than a 5-year time horizon. What's interesting for how we're structured, though, and this maybe gets back to the structure section, is we do the joint ventures with the REIT, and so the REIT actually they earn any outperformance fee, and what that means is if we do a transaction with somebody where they put up 80% of the equity and we put up 20% of the equity, if we hit a return at liquidation, let's say greater than 8% or greater than 10%, we may get 40% of the return above that 8% hurdle, and the other side goes to 60, and that's sort of the way the market works. But what's unusual is that's not usually something that gets done into a REIT, but we did it purposefully. We wanted to have an attractive REIT. We started our REIT with a lot of friends and family, and we wanted to make it a fair return. And so that gives us some optionality that we might not have had when we were going out and just raising transaction to transaction.
Bill, so your guys' REIT actually retains kind of the promote or the kicker on the end.
Yes.
Yeah. Okay.
So it's like a partially internalized manager.
Yeah. Interesting. So yeah, for our side, we've used relationships basically to source deals off market. That's usually how you end up at the seller financing. But like I said earlier, a lot of our deals are either new development, so maybe we know the landowner and we can negotiate a good land price. But outside of that, acquisitions, generally speaking, have just been tougher to make sense on our side of the house here in Texas.
And so, like, another question that's come up a couple of times is around, I guess, inflation and like how are you guys adjusting your property management approach when you're faced with all these kind of rising operational costs, like utilities are on the rise and maintenance in the last few years. Like, how do you guys adjust for the rising cost of everything?
So you want me to go first?
Go ahead.
Sure.
Yeah, sure. So on our side of the house, like on our SFR portfolio specifically, we manage that all in-house. So that's all vertically integrated. We've actually started outsourcing. Part of our team is actually in Asia. They're all direct employees. They're not 1099. They're direct employees of our operating business. And then on top of that, we leverage a lot of technology and a lot of AI, which is one of the biggest buzzwords right now. Whether that's using facial recognition to recognize someone's selfie to their driver's license, or whether that's using AI and automation to send out renewal emails, things like that. So we're doing a ton of things kind of behind the scenes to be really efficient, obviously cutting costs, saving time, et cetera. And then on the maintenance side, costs are definitely going up. we have in-house maintenance techs that are GPS tracked. So, every time they do a work order, obviously we're not contiguous, like, multifamily. So every time they're driving to a property, we're GPS tracking them. We know how long they were at Home Depot, Lowe's, et cetera. But we're using AI algorithms to build out their day and the work orders they're supposed to do. So I do think you're right that, in an inflationary environment like this, any way, we as sponsors can be more efficient and better stewards of LP capital, that's, always the right way to do it. So we're hyper focused on that, definitely data driven. I'll pass it off to Bill.
Yeah, everybody sees the headline when rents were going up, but rents were actually going up in accordance with operating expenses. And a lot of people don't realize that. And, for us, a lot of the challenges were in insurance and actually in property taxes were some of our biggest outliers. So one of the things that we try to do, particularly relative to utilities and things of that nature, is we've converted over 100 properties to submetering. So we don't allocate utilities, we actually submeter. And what you find when you submeter is two things. One, you when it sounds like it's this awful thing to go ahead and say, all right, the property was paying for this charge, but we now revert it over to the consumer, the resident. They're now paying this charge. But what ends up happening is that's almost in lieu of a rent increase the first time you do it. But then what ends up happening is the consumer, now they're in charge of something, and their behavior changes. And so we've seen properties where water consumption's gone down 20 to 50% once we submeter. What we're contemplating, which is not happened yet, is we control the rest of the operating expenses. And so we've experimented with a thing called Ginkgo Promise, and that is your rent's not going to go up other than your rent renewal notice will never be higher than inflation, plus whatever your percentage increase is in your property tax increase and your insurance, because we don't control those two items, but everything else we can control. It's been a difficult thing for us, though, to market to the average consumer who they just want to know what the rent is. And they just want to yell at their landlord when the rent goes up. And I get that, but we're really trying to work on an educational aspect so they realize, hey, we're all in this together. We're just passing through costs. And if we can't keep our costs below inflation, well, then that's shame on us. And we should do that, but we can only control what we can control.
Makes sense. That's great. I was going to ask about AI, but I think you already answered that, Tyler. I have a question that somebody is interested in learning a little bit about SDIRAs. So I have a question that came in regarding like what's the biggest misconceptions about SDIRAs, right? And I think there's a couple, and the first I touched on it a little bit about when I mentioned traditional IRA and Roth IRA. I think most people think like an SDIRA is some sort of special kind of account, right? When it's really all it is just a traditional Roth or a traditional IRA or Roth IRA that allows you to hold alternative investments, and you just have to do it at a custodian that has alternatives, right? And then kind of the second one is that it's complicated or risky when really it's pretty simple. You're just setting up an account like you would anywhere, any other kind of brokerage or advisory account somewhere. You fund the account and then you make an investment. And so it's basically the same thing. It's just your investment choices now are expanded beyond just stocks and bonds. So
hey, Liam, I think that brings up a good point that I think would be helpful for viewers. So if somebody has a deal they want to invest in, what does that process look like for you? And then I guess the follow-up to that is, are you guys providing a marketplace of deals, or do they have to come source, Bill and I to look at our deals, or what, how does that work?
Sure. So it usually right now the way it works is we're in the process of building a marketplace and a storefront so that our investors have a number of options available to them. So right now how it works is either the fund sponsor like you guys comes to us first and brings the fund and says, I want to onboard this because I have some investors I think are going to use their retirement accounts to invest in. Or an individual could come to us, open an account, and say, hey, this is a fund that I'm interested. We reach out to the fund. We get all kind of the pertinent information, the subscription documents, whatever. ownership documents we need from them. We onboard them, usually takes about 5 business days. And so that while we're doing that, we're opening up the account for the investor, and then once we get the funds from wherever the other custodian, or maybe it's an old retirement account, wherever the funds come from, then it invests into that fund that they want.
So basically, if somebody has a Vanguard or a XYZ, IRA, are they funding the entire amount, or are they just funding a portion of it? How does that work?
Yeah, it's up to them, right? If they chose, right, call it, they have $500,000 in an old 401k, and they want to put 250 into, a Staubach deal, they can do that. And so the other 250 can stay at Vanguard, and the 250 that they need for this investment comes over.
Awesome.
Or they could bring it all if they want, but that's like soon, we'll have a marketplace where they'll be able to look at, multiple venture capital, private equity, real estate, all of that will be available to them.
Hey, Bill, I saw a question come in. Being that you guys are a REIT, what does an exit look like for an investor?
Sure. So in a non-traded REIT, what you have is you have quarterly liquidity, and liquidity is established the same way your price on the way coming in was established. We have a board, an independent board of directors that actually values the portfolio quarterly. They rely predominantly at a high level on an appraisal mechanism, an evaluation mechanism with an outside third party. Effectively, you can assume that in excess of 25% of the entire portfolio is reappraised each quarter, which means on a rolling basis they have updates. But then, depending on what the impacts of those appraisals might be, and then other things on prior appraisals, et cetera, they may adjust the valuation of assets out of cycle for certain assets when they're waiting. And so what it turns out to be is you get quarterly liquidity with general price certainty. And when I contrast that against the public market, while everybody loves to say they're great investors, the data suggests that most people are capitulation sellers. They're not opportunistic sellers in public markets. They sell when their assets go down. And so you have this perception of day-to-day liquidity, but it's that rare bird who actually top ticks the market and sells it at a high. In fact, all the volume, the maximum volume days in stocks occur on down days, never on up days. It's like literally, you take the history of down days and like the top 1,000, and there's maybe 100 that might be up days and the other 900 down days. So you have this perception of there's a lack of liquidity, but it's a little bit better to plan for. You get that liquidity quarterly. In our case, because we don't charge anything on our end for any fees, et cetera, coming in for your equity. We have what they call a soft lock structure. So if you invest with us, if you invest in equity with us directly in the REIT, you have a 1-year 5% penalty. So at the end of 1 year, you can get out with a 5% penalty. But you can't get out in the first year, and that penalty decreases 1% a year thereafter, and then there's no penalty after 5 years. I would say we've got probably a third of our equity has been with us more than 5 years at this point. The REIT itself only started about 5.5 years ago, and where we are actually, 6 years. 6 years ago, we've had a total of between everything, we've had less than 2% total redemptions during that period.
Awesome. One more question came in. I don't know who this is directed to. Do you lend as a hard money lender to investors for purchasing residential and/or commercial properties? I'll answer that from our side, and no, we don't touch anything near hard money lending.
Yeah, no, I'm conflicted on that anyways, because I sit on a public board and it would be a competing business.
And
Liam, if you want it, I'm all for it, but that's not me.
Yeah, I mean, Liam, I guess maybe if somebody themselves wanted to be a hard money lender, that maybe there's a way to do that via custodial IRA, but I don't know.
I don't know either.
Well, I'm sure we could put everybody in touch with hard money lenders if they want.
Yeah, absolutely.
Yeah,
if you want to pay 20%.
Definitely.
Well, I'm any other questions, Bill, Liam, any other thoughts before we kind of transition to, how to invest?
Yeah, I think we covered everything. now's a great time to learn more about, how to invest in Ginkgo, like what your offerings are.
Sure. Well, thank you. So Ginkgo REIT is really our primary investment vehicle, but we actually give you 4 different ways to access that. We basically think that every investor is unique and they've got different time horizons, different risk expectations, et cetera. And so we kind of give you a ladder and a stack. Basically, it starts with Ginkgo REIT itself. Again, it's North Carolina and South Carolina centric and exclusive. We own and manage approximately 1.5% of all the apartments in North and South Carolina. And as a result, we're basically an index fund for North Carolina and South Carolina. So it starts with the notes. Notes are 3 months to 24 months. We come out with them quarterly. They're basically priced at 6.5 to 7.5%. Our notes program came about because we found we were paying a lot of money for a line of credit that we weren't really using. The multifamily business is a very efficient asset level finance structure. And so what we found is for periodic capital needs, et cetera, renovation work, we were using line of credit. And so what our notes do is they basically fund our capital programs, and then they periodically get retired out of this through new notes issuance or through a new mortgage that we might put on an asset and extract funds that way with appreciation. Our average note holder, though, does seem to roll. A lot of people will start on 90-day and 180-day programs or build ladders, and they come in that way. And that starts at $10,000. For $25,000, you can invest directly in the REIT. The economics on the REIT are very straightforward. We just covered a minute ago that it's basically, you should think of it as a 5-year investment, but in many regards, it's a 1-year investment, and you can punch out. And you can punch out at 1 year, and if the stock price stayed flat, you're in for a year. You're going to get a dividend that's 5.56%. You might give that back and say, this wasn't for me, and you kind of get your money back at the end of the year. We've never had anybody do that, but I know somebody mentioned that to me one time, so I'd bring it up. The economics on a REIT are really straightforward. We've since we've been in place for the last 6 years, we believe everything we can evidence. We are actually the top performing public and publicly non-traded REIT in the United States. And we generally by a long shot with a lot less volatility. And I think it's because our product is very narrowly focused. We are disproportional to the upside because of the performance fees, and we're linear to the downside. And so we've had a very nice run with good demographics. And so while the REIT might sound like a boring portfolio, it's where my partners and I have a lot of our money, and it's worked out just fine. But the next thing is a lot of people do like to pick their own offerings, and so the REIT, it's minimum 25,000. But what we do is a lot of our direct offerings result from fairly large transactions for the REIT. And what we'll do with that is we'll generally joint venture, and when we joint venture, we'll get a household name who will, people that you would know in the space that would come and provide 80 or 70 or 90% of the capital stack. And then what we'll do, depending on the size and maybe a reverse inquiry, is we'll go out to the existing REIT shareholders, and there's 450, but we'll go out to the usual suspects to see if they have any interest in should we do a sidecar offering. And if that's the case, we'll go back to our partner and who we've already typically carved out an allocation to say, hey, we want to go back and try to raise $2 million or something through the direct offering. And we turn over and we offer that first to the REIT shareholders. And then to the extent it doesn't get filled with the REIT shareholders, then we make it a little broader. So if you're in the REIT and you want to get started with us, if you're in the REIT, you get to look at those. If you're not, you could look at those still, but only if the REIT investors turn it down. But the last thing, and this is becoming a little bit more active right now, is we've done a decent number of tax advantage transactions. And just because of documentation, et cetera, we limit that to 250,000 and above, just because there's cost and structure that goes with it. And so you can basically think of, we'll partner in 1031 exchanges. We've never done a DST, but we can do a DST if anybody wanted to do it that way. But we've done several joint ventures with people selling other real estate where we'll come in, we'll invest in your entity, we'll manage it with you. And if you ever wanted to convert and be in the REIT instead, that would be up to you. We have no right to force that or compel that, and nor do we have a forward purchase price. But that's been pretty comfortable for a lot of investors. And we've done probably 6 or 7 transactions that way since we started the REIT, and they've all worked out pretty well so far.
Bill, before I transition to kind of our offerings and how to contact us, we did get a question. What are the downsides of investing in the REIT fund?
The downside is is you have the perception of of an average return, and I think we've addressed that by aligning our interests by rolling the promotes into there to give people an outsized return. But the second thing is, there is an annual gate, and there's been a lot of advertisement around that with some fairly large players in the market who hit their gate. Part of the reason why they hit their gate, though, is they took a lot of largely concentrated foreign source capital that sort of made a timing bet on their investment. And so when they sought to exit, it became untenable for the REITs. And as a result, the redemption queue went way above where anybody had expected. So where we are is, we started our REIT with a lower redemption queue, and we keep our concentration of holdings lower. So individuals can't really, the average person is not going to be more than a 5% holder. They're probably going to be dramatically less than that. The equity we have in our REIT is just a couple $100 million. So it's call it $205 million. But our joint venture equity is another 350. So we control a lot of equity relatively. But so far for us, redemptions has not been really a big issue. But I would say that's the biggest challenge in doing anything in a non-traded REIT.
Thanks, Bill. So I'll close this out a little bit. Staubach Capital, like I mentioned earlier, kind of single family for rent, multifamily, and then a few different asset classes. If you're interested in learning more about any of them, each of them kind of are a little different. Single family, we're buying upwards of 20% below appraised value, generates cash flow in 6 months, looking to mid to high teens IRR on a 5-year hold. Multifamily developments, generally 4 to 5 year holds, no cash for 36 months while it's being built, and then some cash prior to an exit, generally with that merchant build type strategy. And then industrial, usually it's operating assets that usually start kicking off distributions within 6, 9, 12 months once the business plan has been executed. But really bullish on all three of those kind of pillars of our business. And contact information, my email, or feel free to learn more on our website. With that, I guess I'll pass it back to Liam or Bill to kind of close us down.
Well, a question for you, Tyler.
Yeah.
You have these platforms, plus you do storage. What do you think is the most scalable for you right now in terms of the opportunities you're being presented?
Yeah, no, great call. I think right now for us, we're looking to scale our single family platform. Right now we're at about 800 assets and 100 million deployed. We're looking to get to somewhere in that 3,000 to 4,000 asset mark, which at 3,000 assets, it'd be north of $1 billion in just portfolio value. But we are definitely growing the operating platform to be an entry point for someone with a big balance sheet who wants and needs an operating platform to get into single family. So we're spending a lot of time, effort, energy kind of on that platform, buying brand new assets from national builders.
And is the single family rental pretty similar to what I talked about from a capitulation perspective? Because it seems like it's an industry where there's a lot of people that put layers of debt to get to their smallest equity check they could write to build these things, and it's not working out.
Yeah, I would say, we don't really touch any of the regional builders who I would say are maybe more in that camp where they're stretching to try and put as little equity as possible. From an acquisition side, we only take it from we only purchase from national builders, and then on top of that, we've got a $250 million debt facility with Deutsche Bank. It's at 65% leverage, so similar to what how you guys operate, kind of lower leverage. Our debt is rate capped as well, so we're at, I think, 5.25%. And when we make our next contribution to that debt facility, will likely be sub 5. So yeah, we are definitely mindful of not going to 75-80% of the debt, just because we don't want to be caught holding the bag.
Yeah. What do you think's producing the opportunity that below replacement cost? Just interest rate movements and people can't get their exit caps?
Yeah. So, well, I mean, so since we're buying from national builders, right, rates went up, retail buyers effectively evaporated, which was one of the first things you said on this webinar. And so now the builders are kind of looking up saying, oh crap, we gotta move product, right? And the only way they can do that is to cut their margins. So we may go under contract on a house at 350, but we negotiate seller credits because we're buying in bulk, 10, 15, 20 homes at a time. And then, net we'll close at 275 by way of example. And so our contract price is 350, but we close at 275, so cash out the door, and then the appraisal comes back at 350. And so It's preserving the comps, and obviously the cost to build those homes isn't going down, right? Land cost is going up, construction costs are going up, tariffs, who knows how that's going to impact it. So that's effectively what's happening is Lennar, Century Starlight, DR Horton, whoever it may be, is just forcing to compress their margins, and we're benefiting from those deals.
That's great. So do you foresee an exit where you would get out of houses onesie twosie, or do you see a bulk sale?
Well, I think that you're like asking all the questions. No, this is great. So I think we benefit from flexibility, right? So if we had to, we could sell onesie twosie, we could sell neighborhood by neighborhood, market by market. We don't buy full neighborhoods. So we're direct with Zurich on insurance. So we're actually capped to 15% of a neighborhood. So if you look at Orlando or DFW or Tucson or San Antonio, any of the markets we're in, we're spread across the markets. And so we could sell one by one. I don't think that's the highest and best use case. Our thesis calls for the fact that SFR in general is only 3% institutionally owned. You probably know it better than most, but in multi, it's 55% plus is institutional owners, which I would say, you guys are probably one of those, right? You own a ton of units. And so it's polarizingly different in SFR. So if a big institution wants to come into the space, they really need an operating platform, right? They couldn't go to you or to Willowbridge or to Lincoln or whoever it may be to manage scattered detached SFR. And so we're trying to be a conduit for someone to buy the operating platform along with our assets, because we think we'll get some cap rate compression on an exit.
That's great. Thank you.
Yep.
No, that's awesome. Love to hear all that, and I wanted to, thanks both you and Bill for sharing all your insights today, and thank everyone who joined us. And hopefully it was helpful in understanding kind of the SFR market and multifamily market and the different regions, Texas and Carolinas, and how self-directed IRAs can be a part of your investing toolkit. And so thanks everyone for joining, and hope everybody has a great rest of the week, and we'll see you next time.
Thank you,
Thanks,
Lou.
guys. Appreciate it.